Just picking up on the dynamics that are playing out in the markets today, it seems that euro rally has fizzled and reached a technical resistance level, or is starting to bang against that technical resistance level of 133. It's come back since the announcement of the bailout package. What are the key factors for you that are the driving currencies this morning?
We did see that the risk rally proved very short-lived with regards to that bailout package, and it seems as if market players are really concerned about the dire growth fundamentals in the Eurozone and whether that second bailout package could really mark an end to the Eurozone debt crisis. We don't believe that, we believe that that there's still quite a bit for the Greek market players and policymakers that they need to adhere to actually bring that deficit and that debt down. So it's really going to be quite a tough challenge over the next couple of weeks to see what happens there, and we could see further and renewed pressure on the Eurozone during the course of the day. With regards to the Rand did remain on the back foot this morning, but local developments coming out today with regards to CPI data as well as the budget, we could really see the currency being supported if those data points are proved to be better than expected.
It's sitting pretty much flat as it stands right now. It's, as you say, there has been some some softening in the rand that has filtered through in the past day or so. It's sitting at R7.73 right now. In terms of the budget, firstly, of course, we have CPI as well. But in terms of the budget, what type of big surprises could swing the rand in either direction?
Well, if we do see the budget deficit come in lower than what was initially expected, if that materializes, we could see the rand strengthen during the course of the day. But if we also see a fiscal consolidation as well as support for economic growth coming through, we could also see the rand strengthen during the course of the day. We do believe that the budget is likely to be fairly balanced, but whether we are going to see that jobs growth and the need for jobs growth continue, as well as how we're going to finance the infrastructure spending, that really could put some pressure on the currency.
In terms of CPI, we've got a prediction of 6.2% year on year for the latest month. Those numbers are out at 10 o'clock. It seems pretty much that everyone is in line with that. I don't see any real risks coming through. Would you be of that view?
Yes, Standard Bank's also expecting a number of about 6.2% from the 6.1% we saw in December, but we do believe that the main culprits to that rise in CPI is expected to come from food and fuel. Less so from fuel, given the fact that we did see a decline in the petrol price at the beginning of January, but more so from food. We did see food inflation increase to above 11% in December, and we could see that continue to pressure the CPI number higher. We do believe that the peak of the inflation is expected to be at about 6.4%, which will really take our average of CPI to about 6.2% for this year. Nonetheless, we still believe that the Reserve Bank will probably keep interest rates on hold for the remainder of this year.
But of course, key for the local unit has, of course, been what's taking place in Europe, where sentiment is right now. We had some weak Chinese PMI data coming out, but interesting to note that it's all around the slowing down of the Eurozone economy. In your view, we've got some pockets of hope with money markets, rates coming down and yields coming down. So that, of course, eases funding stresses right now. But then on a longer term perspective, there are concerns about growth going forward. How does this play into the short term volatility that we're going to see on the local unit in the next few weeks?
We do believe that the growth dynamics really plays an important role, but we have seen the rand really being wedded to the euro-dollar movements over the past couple of months, and it's really going to continue along those lines. Yes, we do see solutions come through, but those seem to be quite temporary, and the euphoria surrounding that also seems to be quite short-lived. So it's really going to be impacted by what's happening in the eurozone and whether we really can see the Greek debt crisis really turn around over the next couple of weeks. In my view, I don't believe that that's possible, and it's still going to be quite challenging over the next couple of weeks. So we could see the rand remain under pressure. Although in the short term, as I mentioned before, we could see the rand take some direction from local developments.
Well, of course, it's international and local developments that have impacted that euro-dollar, specifically with regards to the euro. It's also the dollar that we need to keep our eye on in light of the news flow around the economy in the United States right now. Housing data out at 5 o'clock today from the States. Are we going to see increasing an improvement really on that end that could be supportive to the dollar?
It could support the dollar, but as I mentioned again, it's really the main data points like the unemployment data, for instance, and the retail spending numbers that's really going to impact on whether we see the United States show a turnaround as well. Retail spending has been pretty subdued at this point, and the unemployment data with regards to jobless claims is not really showing the same kind of strength that it's needed to see the United States come out of the bleak situation that it is in at the moment. But with regards to the housing data, we could see some support for the dollar later today.
So really, retail and employment data are more key for you right now in terms of the health of the United States economy. Shireen Darmalingham, Macroeconomic Strategist from Standard Bank.